answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hanson and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hanson and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth Financial's Money Matters. This is Pat McClain, and today I have a special guest, David Schauer. David, thanks for being on this show today.
Good to be here.
If you're a podcast listener or terrestrial radio listener, you're probably thinking, where's Scott Hanson? Well, Scott Hanson's had a family member, not a child or his wife, who had some medical issues. And Mr. Hanson is flown to Southern California to spend some time with that said relative. So, but David, if you've been a listener to the show for any length of time, he is a guest often. And in fact, if you subscribe to our newsletters, you might see his quarterly commentary on the markets as well. So David has been with Allworth for how many years now?
About 22.
22 years, and he is a MBA.
Not exactly, but
what is it?
MS.
Okay, master's in
finance,
and then a chartered financial analyst, a certified financial planner. So he not only is a practicing advisor that works with people just like yourself on a daily basis, he helps steer the investment committee in the portfolio. So great depth of knowledge. I often like to refer to David as the smartest man in the room.
Which is definitely incorrect.
But you started here. How old were you when you started?
I was young. 22.
22 years old,
Yep.
Right out of college.
Right.
Came in doing trades and working with us. And, you know, it's been fun to watch David's growth through the organization. And I don't talk much about this, but we have a program that we work with local colleges where we have an internship program where students in finance come through the organization while they're in college. And I believe we've hired...
We've hired at this point 4 full-time, actually 5, and we have another 2 interns, if you will.
So it's, and do you run that program or?
Yes.
So David actually selects, and
I take it back 6.
6.
Sorry, I'm going through people as you speak. So yes.
6 people that have started as interns, and it's a hard. This is what the interns have told me, that it is a difficult position. There's lots of applications for the internships. Is that correct?
There is. Yes.
So, and the 6 that we have hired have, not all of them have progressed to be financial planners. Some work in our plan benefit division. Some have gone over to accounting, and many of them actually start by supporting financial advisors and then moving into that role full time.
Yes,
so,
there definitely is a learning curve.
Yes, there is. There is. Anyway, so enough about us, and thank you for being here again, David. We're going to take a ton of calls. This hour, we are going to answer questions. And if you'd like to join the show, 833-99-WORTH. That's 833-999-6784. 833-999-6784. And we'll go right to the calls. And if you'd like, give us a call, and we'll get you on the air. We're talking with Betty. Betty in California. Thanks for joining Allworth's Money Matters.
Absolutely. Thank you so much. I'm looking forward to a conversation.
As are we. What can we do for you?
Well, I'm very interested in changes that are taking place with regard to IRAs. I have a 401k. I'm a sole proprietor of a small business. And my plan in terms of contributions to the IRA was to really forward to beneficiaries. I understand now there's a lot going on with regard to eliminating the stretch IRA. So what I would like to explore is what the opportunities are to be able to transfer those funds into a Roth.
All right, and so let me ask you a couple questions. You said you're putting money into a company. You're sole proprietor, so you have what is often referred to as a UniK or self-employed 401k. Is that correct?
That is correct.
And I assume you have no employees. Is that correct?
That is correct.
Okay, and what is the approximate balance in that 401k?
About about a 680.
Okay, and do you have any money in IRAs?
Yes, I do. The same amount.
So you have approximately
but two separate accounts.
Okay.
The sole proprietor 401k is the one that I wanted to explore most in terms of looking at being able to transition into a Roth.
Got it. And what is your approximate income?
About 240.
And I know it's rude to ask someone's age, but it's kind of germane to the conversation because distributions from IRAs are actually triggered by age. What is your age?
Absolutely, and that's not sensitive at all. The age is 79.
And you're still working?
Absolutely.
Oh, good for you. Good for you. So you've obviously started your required minimum distributions.
Yes,
Okay.
yes, at the required point of 70.5.
Okay, and are you giving any money to charities? And if you are you using the required minimum distributions to do so?
No, I have not done that.
Okay. Are you if you are giving money to charities, that should come out of the required minimum distribution first. And
I understand that, and I've decided that charity begins at home in terms of family.
Perfect.
Sure.
All right, so David, do you want to talk a little bit about the changes in the required minimum distributions in the stretch IRAs?
Well, with the required you're not referring to qualified charitable giving. You're referring to the going from a beneficiary stretch to, let's say, a 10-year stretch.
Correct.
So that's kind of really what they're looking at, is just taking it from potentially a 20 or 25-year or longer stretch provision to really capping that at 10 years. So depending upon how many beneficiaries you have.
And their marginal tax rate.
Exactly. It may not be much of an issue. I mean, generally, I'll say how many people actually stretch their IRA to the greatest extent possible. It's a very small percentage.
Very, very few. So how many beneficiaries do you have?
2.
Okay, and are they in a lower marginal tax rate? And you might not know exactly, but you can guess. Are they in the lower, the same, or higher?
I don't know that exactly. I would think that they would be, yes.
In a lower?
Yes, that's correct.
Okay, so if your income wasn't $240,000 a year, this would be a relatively straightforward way to deal with it. But as a matter of course, if you're going to do a Roth conversion, you're taking dollars out of a qualified account and you're paying taxes on it in order to right now, and then you're converting it. So it grows tax deferred, it comes out tax free. You're doing it at your marginal tax rate.
That is correct.
If your beneficiaries are at a lower marginal tax rate, then it is not a good idea to do that. And the reason is
that's really helpful for me to hear.
Right, and it
now, if your income dropped, do you anticipate working to the same degree now, a year or 2 or 3 from now? Will you slowly fade your income?
Probably 12 to 18 months forward, and after that, no, then it would be reduced significantly.
So that is the time that you would explore conversion to the Roth IRA from the IRA, because many people just think about themselves when they're doing the Roth conversion, and really what you want to, and you had stated, charity begins at home, that the purpose of these dollars is to spread them downstream. You pulling money out and paying at a state and federal tax rate of 40% plus, And by the way, Betty is in the state of California. And
Yes, that's correct.
and then your kids receiving those dollars tax-free when they could have actually pulled them out at 30% or lower makes no sense whatsoever. You would actually be paying the government more than you had to. Now that's
Okay, that is really good to hear
Yeah.
because that was not something I'd considered at all. That's very, very helpful.
And so in a year and a half from now, if you're no longer working, then at that point in time, call the show and we'll actually crunch through the numbers.
through it.
And actually, in our situation here, we have Allworth Tax Services, and we involve accountants in not only the CFP or the advisors working with the clients. We oftentimes will involve our tax services division in those calculations so that we can project out multiple years to do that. Now, the question I then ask is, how much money do you have outside of these IRAs or Roth IRAs?
Solo case.
Or solo case?
Let's see, right around 300.
Okay. And, one of the things you should be looking at, and I assume you seem pretty educated, I'm sure you have a stock and bond portfolio. Is that?
That is correct.
You should really be considering whether you should be keeping more of your bonds in the IRAs and solo Ks and the stock outside of it. Right? So think about this. Bonds, you derive income from them, and you will get a step up in basis, but you're not assuming any real capital appreciation in your bond portfolio. It's primarily as an income and an anchor or a floor on the portfolio. Mm-hmm. And stocks, actually, at your death under current tax law, receive what's called a full step up in basis. And most people have it backwards. Most people will have more equities inside of their portfolios and less equities outside. And it's the other way around.
So Betty, with that 300,000, what is generally your allocation with that 300 that's outside of retirement plans?
I'm sorry. Would you ask that again? I didn't follow that.
Sure. The 300,000 that you have outside of your IRA and solo K, is that mainly? How is that broken down between stocks
cash
and bonds?
or stocks, or what's it invested in?
That would simply be in savings.
Okay,
it's cash.
So this is exactly. So if you were sitting in a qualified advisor's office, and I most certainly would include Allworth in that equation of qualified advisors, the first thing to do would be determine your risk tolerance or what you needed to do with the portfolio. So we'd say, okay, let's assume Betty needs a portfolio that's 50-50, and you probably know what that is, how much you have in equities versus stocks or bonds, equities being a stock, how much you have in bonds and cash, how much you have in other things. And then you say, okay, it needs to be 50-50. That's the first thing you do. The second thing is, which is the most tax advantage manner to hold these, inside the IRA or outside the IRA? And from what you've told me so far, unless you have a complete bond portfolio, if you have equities in your portfolio, those should be represented in the money outside the IRA.
And Betty, just another question: is the 300,000, or if I back that up, do you have a trust?
Yes, I do.
Okay, and the 300,000 is in the name of the trust?
That is correct.
Okay. So that's I know you didn't ask the question, but you were asking about tax efficiency, and that's the next question that you need to answer yourself is, do I have the right assets in the right accounts in order to achieve my objectives? I mean, your objective is to push it downstream, which means the equities, especially if they're index funds or individual equities, you want them outside of the IRA, not inside.
That is all such helpful information, and it's the first time I've heard that type of an explanation and a strategy. So thank you. That's very, very
Well, I appreciate
helpful.
the call, and I'm glad you enjoy work so much. I personally hope my wife enjoys work at the age of 79 years of age. I don't know if she would agree with me.
Well, I appreciate that. This is very helpful.
All right.
It's been a bit stressful deciding, what I needed to investigate. So this simplifies it tremendously.
It's easy. All right. Appreciate the call. And let's go to the next caller. We're going to talk with John. John, thanks for joining Allworth's Money Matters.
Well, thank you.
What can we do for
John.
you?
Well, I'm at a dilemma here. I've got about 650,000 between a 401k, an annuity, and about 50,000 in cash. I have a house that's worth about 600,000, but I owe 212. So I'm wondering if I should pay down the house either 100,000 or pay the 212,000 off completely, and which would be more advantageous to do. It's kind of a tough decision. I've heard other people, when they had only owed 100,000 on the house, it's kind of a slam dunk. Go ahead and pay off the house. But I'm kind of not quite at that point.
And are you working today?
I'm 1 day a week, so I'm bringing in a little bit. I'm bringing in about 1,000 a month or so.
And how old are you?
I'm a pair of sixes.
Okay. And do you have enough money to live on in terms of income? Are you taking any money out of the annuity or the cash account or the IRA on an ongoing basis?
No, not yet.
Is the annuity a retirement account, or is that an after-tax annuity, a non-qualified annuity?
It's a retirement account.
Okay, so it's a 403b. You worked at a hospital or a nonprofit or a school.
No, it's an annuity that I purchased about
inside the IRA
6 months ago. So yeah.
Okay.
Okay, we're gonna circle back on that here in a minute. What's the interest rate on your house?
3 5/8.
All right. So here's a general rule of thumb, which is we like people to go into retirement with their house paid for. But if you don't get there, then maybe what you do is you have the longest mortgage possible, and you have the longest mortgage possible, and you realize you're never going to pay it off. And you're just then managing for cash flow. So in this situation, how much time do you have left on your mortgage?
About 20 years.
Okay. So I have.
But I should mention to you, my wife is a bit younger than me, 13 years younger. So she's still working, and between what we have going on, we've got 5 streams of income right now.
What's your total income approximately?
A little over 10,000 a month.
And that's take home, or that's gross?
That's gross.
Okay.
So if I were to do anything, I might take some of the money out of the savings account and push it against there and ask them to re-amortize the mortgage. What's the current interest rate, David?
Not too far from that.
Okay, so it doesn't make sense to refinance it.
No, what I was thinking is how much longer is your wife going to continue working?
She's 54, so probably another 8 years.
And is she participating in a retirement plan?
No, she doesn't have any retirement plan going.
So
I'm the retirement plan.
Sure. With respect to your kind of discretionary income, for instance, let's say you wanted to pay off the house over the duration of her working years, so 8 years. If we ran the number, do you have room in your monthly budget to put more against the mortgage?
Yeah, we probably do.
How much?
Probably a couple thousand if we really were pressed to do it.
And David, why?
Well, it just gets them to a point where when she does retire and her income presumably is going to drop away
a lot,
there's going to be a pay cut of sorts, and you wouldn't have to take the tax hit that you would have to take today to pull from the 401k and the annuity to pay down the house. And it would go ahead.
Oh, and so how much does your, John, how much does your wife make gross on a monthly basis?
She's gross is about $4,000 a month.
So I'm kind of following you. I kind of like where David is going with this, which is if we can get rid of the house payment by the time she retires, then you're essentially you could probably keep your income relatively stable. Because when you think about a mortgage, money not going out is exactly the same as coming in when you're in retirement. And where's that money coming from to pay that mortgage off over the next 20 years? It's going to come from your IRAs or your savings in some form or fashion.
So what's your current principal and interest payment?
My interest is 3 5/8, and the payment's $1,800.
And that does not include taxes, or it does?
No, that includes tax.
So it's probably around $1,500 a month.
So I was gonna say, if you make a payment of $2,550 for just principal and interest, so let's say you increase your payment by $1,000 to $1,100, it pays you off your mortgage in 8 years.
And what's wrong with taking some of that $50,000 in the bank?
Sure, absolutely. I just don't know what their comfort level is of taking that down to a point of.
But he's 66 years of age, and all that money that's in his IRAs is completely accessible to him without penalty.
Agreed. It's just taxable.
So, so maybe you take $40,000. You take $40,000 out of the savings, and you put it lump sum down on the mortgage, and then you re-amortize the mortgage, which means you figure out what the payment is, and David will give it to you here in a second, so that the house is paid off in 8 years. So your wife retires in 8 years. That $4,000 a month goes away, but at the same time, that $4,000 in income goes away. At the same time, your expenses go away by a significant amount.
So if you dropped, I just did the math. If you dropped $25,000 on the mortgage, so it kept you at $25,000 liquid, your payments that you'd need to make a payment of about $750 more per month to pay it off in 8 years.
So you'd have to make a payment of $2,350 a month. And I like that idea. That's the best way to do it. Taking the money out of the IRAs and doing it there is probably not the best idea, because there's great likelihood.
Put them in the highest tax bracket of their life going forward.
Yes, you're going to drive yourself into a higher tax bracket, and this actually will have no effect on your tax bracket whatsoever.
So the $2,350, is that putting a chunk of money down cash?
Yes.
25. Yep.
Yeah,
So,
taking 25 of your 50 that's in cash.
Okay.
Putting that as a one-time payment on the mortgage, and then changing your payment. Increasing it by $750 a month, then changes the payoff from a 20-year mortgage to an 8-year mortgage.
Okay.
and leaving the IRAs alone.
That would be getting a whole new mortgage.
No.
That's just you changing your payments.
Just changing your payments.
I just add the extra.
Correct.
That's right. And in the memo box, right, apply to principal.
Principal only. Okay,
got it. Yeah, and that's it there now. So that's the answer to that. That's a simple. Tell me about the annuity you purchased 6 months ago and why.
Well, I was dealing with one company to purchase an annuity, and that didn't work out. I was lied to, and so then I went with somebody else rather quickly, and just wanted some stability and not have anything. I didn't want it to go down. I wanted it to gain something but not go down.
And did you buy an indexed annuity?
I don't think it's an indexed annuity. It's just the last 10 years it was averaging 6.8%, but the last 10 years everybody did well.
Yeah, that's a different story.
Yeah.
So I would have taken probably a little bit different tact in that, just because of the cost associated with annuities, which is I would have probably overweighted your portfolio a little bit more fixed income to take the risk out of the portfolio and not bought the annuities. And the reason is, this is not so much for you, John, but it's for the rest of the listeners. What does an insurance company actually do with that money that you give them inside of that annuity, right? What do they do with it? Well, they have the same access to the investments that you do.
Right.
Same access. So what they end up doing is they end up buying bonds in their portfolio, right? So what they did is they added a layer in the food chain to your portfolio that paid a salesman a commission to buy that, and that was paid a commission, and they stuffed it full of what you could have had in your portfolio anyway for a lot less money, which is lots of high quality, either U.S. government or high quality debt instruments, primarily bond. So and what you were trying to do is what we've seen many people do, is try to isolate themselves from what they believe to be perceived risk in the portfolio. And in fact, later on, after the break, we're going to talk a little bit. So I appreciate the call, John, and thanks for joining us on air. After the break, let's talk a little bit about these indexed annuities. Great article I just read about how these insurance companies are actually kind of, how would you say?
I would say almost gaming the vernacular that they're using, meaning indexes. Anyways, we'll go into it.
Yeah, we'll talk a little bit about it and why there are lawsuits that are starting against these insurance companies, and why there'll be probably many more in the future. So we will do that after the break. If you'd like to join the show, it's 833-99-WORTH. It's 833-999-6784. And we've got David Schauer on today. As I stated at the beginning of the show, Scott Hanson has a family member who is having some medical issues, not his wife or children. For those of you who know Scott, it is not his wife or children, and he is taking some time off work to spend with that family member. So we will be back right after this.
Do you have a financial question that needs answering? Call us at 833-99-WORTH. That's 833-99-WORTH. Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters with Pat McClain and guest today, who's a longtime associate here at Allworth, 22 years, David Schauer, master's in...
Good to be here.
Master's in Finance, CFP, Certified Financial Planner, Chartered Financial Analyst, and Mr. Hanson is out today helping one of his relatives that is going through some health issues, which is... Earlier in the week, I was meeting with the management team here at Allworth, and I spent a couple times talking about seasons of life. I spent a couple minutes talking about seasons of life and how the organization of Allworth is a collection of people, which all organizations are a collection of people, and that if we strive to make Allworth one of the premier places for people to work, we have to recognize that everyone has different seasons in their life. Everyone. And not just seasons of career seasons where, there's a growth phase or there's a leveling phase or there's a retirement phase, but the little stuff like, a sick child or parent or spouse or marital difficulties or mental health issues or whatever it is, right? That we need to, as an organization, not only recognize it, but embrace the fact that everyone has a seasons of life. And, I can tell you, I've been here for almost 27 years, that at Allworth, that I have personally had many seasons of life, some great and some just absolutely horrific.
Sure.
And that, anyway, so this is one of the seasons in Scott's life where he's got responsibilities above and beyond that of his clients and his workplace where he needs to be there for a family member. And so that is why Mr. Hanson, Scott Hanson, is not here today. So anyway, we're going to take some calls about your money. If you'd like to join the show, dial 833-99-WORTH. That's 833-99-6784. Or you could go to our website, allworthfinancial.com. We're going to go to the phones. We're going to talk with Dan. Dan in beautiful San Antonio, Texas. Dan,
gentlemen, thank you for taking my call.
Well, thank you.
I am in the fall season of my life, getting ready for retirement, and I want to be able to protect my investment. So I want to get your read on something.
All righty.
So stories in the media have been abundant about the trade wars between the U.S. and China, and obviously it impacts the stock market on a daily basis almost. And I'm concerned about the amount of investments the Chinese government really has in the United States, be it in stocks, bonds, real estate, etc. So how do I, as an investor, evaluate my holdings or future holdings and really look into the amount of influence that China may have in my investments?
Good question. Good question.
And we're assuming they're doing it given your thesis, in a transparent way, because I suspect, for instance, Chinese own maybe $1 trillion of U.S. Treasuries. That's a common knowledge. That's accounting. They are on record as owning that. Kind of what I kind of hear in somewhat of what you're describing is through other subtle means. Maybe through shell companies, what have you, owning shares in a myriad of corporate U.S. companies. That's that's going to be a more difficult thing to try to uncover as to, for instance, let's say a foreign mutual fund that owns shares of said large cap company. Is that foreign fund that may be domiciled in China backed, or government money in that? That's I don't know that that's uncoverable at this point.
But I would take it one question further. It's what's dangerous in the portfolios, the risk you can't see, not the risk you can. Right? So you're asking about a risk that you can partially see.
Right.
And a risk that you can't partially see. So this is it's emotionally it's on your radar because, as you said, it's the fall of your life and you're getting ready for retirement. Did you worry about this 10 years ago? Were you worried about external forces 10 years ago? Because I could go back the last 50 years and give you every reason in the world that you should not have invested based upon things that were happening in the global environment. Every reason. Mm-hmm. We could go back to,
Cuban Missile Crisis.
We could go back to, Bill Clinton's impeachment. We could point at Donald Trump's impeachment. We could go back and give you a scenario of all the bad things. What really needs to be done is recognize that the thing that will put your retirement off track or derail it is the amount of risk with a given rate of return in your portfolio and your distribution rates. That's what we know. So you say, well, how old are you, Dan?
61.
Okay. And are you married?
Yes.
Okay. How much money, or how much of as a percentage do you plan on taking out of this account?
Upon retirement.
Well, it's basically a 401k.
Okay, and what's the size of it?
So it's about $800,000.
Okay.
And probably $3,000 a month.
Okay, so
over extended. Obviously, in the fall of my life, I still have the winter to go.
Okay, and do you have any debt? Is your home paid for?
No.
It's
so that's the only debt that I carry. Yeah.
How much do you owe on your home?
$230,000.
Okay. And is there any other money outside this 401k?
Yeah, I get a government annuity.
Okay.
Will you also,
when I retire.
Will you also receive Social Security or no?
Yes.
Okay.
So you're going to take $36,000 a month out of this account.
A year.
I'm sorry. No. $36,000 a year.
Whew.
So you're at about
a month would kill me.
You're at about a 4.5% distribution. So what happens in a situation like this is if you build an allocation and you recognize that is the allocation, the worst thing that can happen to your portfolio is to change that allocation based on external events. So we saw it in the recession where people had a 60-40 or 50-50 allocation, and they changed that based on market volatility. What they did is and
generally not in the positive direction.
Correct. They didn't increase their equity exposure when the markets are down. People typically decreased it.
Decreased it.
right?
Right.
Which is so you ask yourself, number one, did you do that during the last recession? Did you decrease your equity allocation, your stock
I
allocation?
did not.
Okay.
No.
And you've been putting money into this for how many years?
25.
Okay. And do you know what the allocation is approximately between stock and bond?
Well, because I get to pick it. I would say 60-40 to bonds, stocks.
Okay,
60% bonds.
Okay.
Okay.
I
I think that's within the realm of what's reasonable,
I think
given what how the conversation started with a bit of concern towards
the
volatility.
Risk. Yes,
and
I
risk.
get that, but the distribution is a little bit large for
Yeah,
that.
but is your concern? Do you need to leave 800,000 to anyone at the end of your life,
No.
or are you okay bouncing your
I
last
do.
check?
I am good at bouncing my last check.
Okay.
I would lower the distribution to probably $2,500 a month.
Okay.
Given the fact that you are 60% bonds and 40% equities or stocks, and net of fees, at least to start the retirement.
You'll be what age? 63 in retirement?
He's 61 now.
Right.
63, 64.
Okay.
Yeah, I haven't picked the specific date yet.
Yeah, so I listen to other financial talk show, and people say, well, we've got an active allocation and we know when to get out of the market and into the market. That's all garbage. That is garbage.
I agree with that.
Yep. No one knows, right?
Correct.
No one knows over a period of time what it is. And then you look at some of the best minds in investing. The Warren Buffett. What did Warren Buffett do during the last financial crisis? He was buying. He wasn't selling. He was buying, and he had the ability to do that. So I would stick at 60-40, not worry too much about China, and then I'd lower the distribution to $2,500 a month.
Well, the other thing you could do would be you keep your distribution in terms of where you want it, and you work until you have enough money. So, for instance, you work until you have $900,000 in your retirement plan. So, if that's 2 years, great. If it's 2.5 years, if it's 3 years, that would be a way to, I think, be consistent with what Pat's saying in terms of a percentage. So that the money that you mentioned, the $36,000 a year, would be within the realm of where he's saying he's comfortable based upon that that different dollar amount.
Yeah, and what drives that? If your portfolio was a little bit more equity weighted, and I'm not advocating for that, given your risk tolerance, I'd be comfortable with a higher percentage distribution over a long period of time. But even then, David's comfortable telling you that $3,000 a month, recognizing that the likelihood that you're going to use some principal is higher than the $2,500 a month.
But that's okay.
But that's okay, right? If the last check you write is supposed to bounce, which is, by the way, very, very difficult, because typically if the last check you write bounces, you've probably bounced other checks in your life as well. So,
good point.
Anyway, appreciate the call.
All right, thank you.
Take care.
I like San Antonio.
Yeah.
I went to the Alamo. It was like a big fort.
I thought you were going to say you like the Spurs.
I'm not a fan of the Spurs. Anyway, we're gonna take some more calls. If you'd like to join the show, that's 833-999-6784 or 833-99-WORTH, and we'll get you on the air. Oh, after this call, let's talk about we talked to the first half of the show about these index annuities and what's going on in that marketplace. So we're going to talk to Terry in California, and then we will cover some other topics. Terry, thanks for joining the show.
Well, I've heard on past shows that you recommend that when financially feasible, that people should max out their retirement plans.
That's correct.
I'm familiar with like the 401ks and 401 Roths and traditional IRAs and Roth IRAs. But I know there's a lot of other different types of retirement plans out there, and each of them have different maximums and whether or not you can if you're over age 50, you can contribute more. But and there's different combinations of retirement plans that people are eligible for.
That's correct.
So, I mean, I'm a salaried employee, so I know that I'm probably restricted to the 401ks and the IRAs. But are there maximums, and are there different combinations of maximums, and do they phase out at different salaries?
Yes, and yes. There are any number of different plans available to different people based upon what their employer offers and what type of job they have. So,
And their income.
and your income, and then whether you can deduct IRA contribution or not deduct an IRA contribution. So as an example, you could work for a county and you could have both what's called a 457 deferred compensation plan available to you and a 401k, but only if you work for either a state or municipality, where you could be in a nonprofit and have access to either both a 403b and or a 401k. So it is all different. So rather than us try to talk
Go through
about every derivative, let us ask you some questions, and then we'll answer your particular question.
Sure. What do you have available? What do you have available to you?
I have money in a 401k, and I have money also in a traditional IRA and a Roth IRA. Supposedly, I haven't investigated this, but I could get my 401k done after taxes. So I'm assuming that's a Roth IRA or 401k.
No, we'll circle back around to that, but okay, go on.
So that's what I have available for me.
So to be clear, you're maxing the pre-tax nature of your 401k?
Yes.
And the employer does not offer any other employer-sponsored plans, correct? No 457, no non-qualified deferred compensation. Okay.
And what's your approximate income?
About 160.
And your age?
54.
And how much are you putting in the 401k now? Completely maxing with catch-up?
I'm not doing the catch-up yet. So I'm thinking it's about 19,000.
Okay.
And are you making contributions into an IRA or Roth IRA in addition to the 401k?
I mean, this year I put 6,000 into my Roth IRA earlier in the year.
Okay.
All right. So,
what do you have in additional income that you can deploy to savings?
Basically, it's just my salary.
So could you save another $5,000 or $10,000 a year?
Oh yes, I could.
And where is that line? That's what we're trying to figure out. Is it 5? Is it 10? Is it 20?
How much more can you save?
Oh, I could probably save another 10,000.
Okay.
All right. So the first thing to do is to use the catch-up on the 401k.
Yep. That's gonna take 60% roughly of the 10 you're looking at, and you're gonna get a tax benefit. What in retirement? Will you have a pension?
No.
Okay, so it'd be Social Security and whatever you draw from your savings, correct?
Correct, and any other savings I might have at the time.
Sure.
And are you married?
Yes, I am.
And does your wife contribute to? Is she employed outside of the home?
Yes. She doesn't make that much, though.
Does she have a 401k available to her?
I think she does.
Okay, well then
She's not contributing.
Yeah, well there we go.
And the other option would be, do you fund a Roth for her?
No, not yet.
Okay. So that's is she younger than you or the same age?
Same age.
Okay, so so we're gonna tick through the boxes, right? Do the catch up on your 401k. Make sure the allocation is appropriate for you. So you actually want to take the portfolios and build a portfolio. Make sure that it is appropriate for you in terms of a risk return ratio and how much equities versus bonds and other things in the portfolio. You want to do the maximum, including the catch up on yours. You want to do the maximum, including the catch up on your wife's, and then you want to take the difference and you want to make contributions into Roth IRAs for both you and your spouse. So you got a lot of room.
So how much can we contribute to the Roth IRA outside the 401k limits?
So it's driven by income, but there is a way around that a little bit, and this is a little bit complicated, but I will attempt to explain it to you. What you could do is you could take your existing IRAs and transfer them into your company 401k plan, right? Take your existing IRAs and transfer them back into your company 401k. And then you can make a non-deductible IRA contribution into your IRAs. You don't receive a tax deduction on it, but there's no income limits on that. And then you convert that to your Roth IRA the very next day.
Is that what's called the backdoor conversion?
You could call it whatever you want. I've heard it called half a dozen different things, depending upon. But the code, I don't believe, the IRS code doesn't call it backdoor IRA. But yes, that would be one of the terms that it's used. And the reason you're doing it that way is if you don't do it that way, when you do the Roth conversion, it's on a pro rata basis, and it may cause some of your IRAs to be taxable. So,
but right now you're not. What's your combined income? You mentioned I think 160 earlier. Is that just you, or is that household income?
That's just me.
And what's her income?
Might take it up another 20 or 30,000.
Okay, so I don't think you'll have to go through the backdoor kind of structure. I think you could just focus directly on contributing to her Roth, your Roth, and then I would at least do, to the extent that she receives a match, have her put money into her 401k to at least get any free money that's available.
So you want to do those four things.
Okay.
All righty?
Yeah, that sounds good.
All right. Appreciate the call.
All right. Thank you very much.
Thanks.
Take care.
Yeah. There is.
No, there's a lot of options, and then even the after-tax 401k was going to be something we didn't get to, but that would be even another and backdoor.
Oftentimes that's dependent upon the size of the employer and how many participants are in the plan, and whether the plan's top heavy or anyway. Hey, before we go back to the phones, we're going to talk real quickly about this article that I read recently, which is this came out of, where am I? Investment News?
Yes.
Investment News. And it was an article, and it is titled, Security Benefit Indexed Annuity Fraud Lawsuit May Signal Trouble for Other Insurers. So Security Benefit Life is a large seller of indexed annuities. And this is a lawsuit that was filed by Howard Rosen. And it targets the insurers' indexed annuity products and their own proprietary indexes. So here's
basically the way it was sold.
Yeah, this is how it was sold. So here is a quick background on indexed annuities. Index annuities, the sales of index annuities they've skyrocketed in the last 10 years. And part of it has to do with these insurance companies and salespeople feeding on the fear of volatility in a marketplace. So what did these insurance companies tell you? Well, the insurance companies come to you and they say, hey, look, here's the deal. You put money in here, you wrap it up for 10 years. If you take it out, I'm going to charge you a big surrender charge, sometimes 10 to 15% of your deposit. But if you keep it in there for 10 years, I'm going to allow you to participate in the returns of a particular index.
A portion of it.
A portion of it. And sometimes it's capped on a monthly basis, quarterly basis, annual basis.
And that excludes dividends.
And it used to be that the S&P 500 or the total market was the index that they would use. And they would say, hey, look, if you put your money in here, you're going to get at least 50% of the returns of the market.
As an example.
As
right?
an
Some
example.
of them are much lower than that, but yes, go on.
As an example. And you can't participate for any more than 5% in any one particular quarter. So what this does was it kind of limits the risk for the insurance company. And as I mentioned earlier,
it does
about what insurance companies do. What is the insurance company doing with your money to make it so magic that they can do this?
They're buying bonds.
They're buying bonds. And then what are they doing with the income off the bonds, David?
They're taking some of it, and the rest of it they're deploying to paying those returns.
And they're using options on some underlying index. So
Yes.
they're buying options on an underlying index. Well, the insurance companies are like, wow, we could get ourselves in trouble here because we have downside and we don't know what these options are going to cost on a particular index. So what they started doing was creating their own index.
Well, furthermore, as we've seen participation rates come down.
What is a
meaning
participation rate?
how much you get, the cap, how much you get as a percentage of said index. So 10 years ago, it might have been 50 or 60%. It might be down to 30% today. So your ceiling is much lower.
Which means that you're not going to participate as once you
Correct.
thought you once were.
So from a sales perspective, it's not appealing to buy. So you might see sales sag. So what did they do?
They created this whole new
Index.
index which actually they knew going in how much, historically speaking, how much volatility or rate of return these particular hybrid indexes. So what they do is they mix 2 or 3 or 4 different indexes together.
And put in other asset classes and structure it in such a way that you would never see the upside potential. And so therefore they could take off the participation rates or the caps and sell it as we don't have a participation rate.
These are so difficult. So if you're listening saying, what are these guys talking about? They're difficult to understand if you do not have a background in finance and most certainly a background in insurance product or structures. My guess is that half the people that are selling these things don't quite really understand how they work. But this is just another reason that you hear us harp on a continual basis about index annuities and why we don't like them. It's one more smoke and mirrors, a reason for these big insurance companies to collect high fees on your account. So anyway, we are about out of time. We appreciate you joining us. We are here each and every weekend, and as always on your favorite podcast provider. And if you are listening on podcast, if you would do me the great favor of going in and rating us and even sharing it with a friend or two. So we will see you same place, same time next week. You've been listening to Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.